Hello, very good morning to all and happy Friday. This is Kelvin here again. Welcome to today's Daily Dose of Market Insights and very good morning. Today will be Friday, the 12th of July 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into our short-term intraday technical outlook for today, there's very interesting market events as well as these events on their impact on the key major cross asset classes that I have to share with you all first before we jump into the gist of the short-term intraday technical outlook for today on the major dollar pair, the major stock indices, and as well as the two key commodities that we cover, XAU/USD, that's gold, and West Texas crude oil. So let's start with yesterday's important data releases first. As we all know, yesterday we've been talking about the US CPI data release, which came in within market expectation. So market is expecting the data to actually soften over here. So let's take a look at the data, the data point, I would say. All right, so very quickly on the economic calendar. So what we could see over here is that the core inflation rate year on year managed to actually inch down is what market is expecting, and even slightly below market expectation of 1 basis point. Market is expecting 3.4%, it inched down lower. So if you look at the trend of the core inflation rate that is excluding energy and food prices in the US, is clearly showing signs of a deceleration. Okay, so yesterday level of 3.4%, it's the lowest level. Okay, let me put it in the 5-year trend. Okay, 3.3%. So it's the lowest level since April 2021. All right, so very clearly since March 2023, it's clearly on the path of deceleration. All right, and even we're talking about services inflation, where some of the US Federal Reserve are still concerned of it being elevated, has also shown signs of a cool down as well. Okay, so this is services inflation. Right, so you look at the services inflation over here, also ticked down pretty significantly as compared to the May and April. Now it's at 5%. So you look at the trend, okay, it's slowly inching down as well, but much at a slower pace compared to the core inflation. But nevertheless, the fact that it's inching downwards. So that is more or less has put baked in the high expectation before the release of this US CPI data as inferred by the CME Fed Watch 2. So for those who follow my daily dose on a frequent basis, I've been highlighting that the Fed funds interest rate futures market has really priced in, or almost with high odds, that 2 interest rate cuts will more or less be settled before 2024 ends. So this is what I mean over here. All right, so if you look at the CME Fed Watch 2, for those who are seeing this at the first time, I hope so, not so, because I've been talking about this since the start of my daily dose, I think more than about 8 or 7 months back. So this is a good tool, a free tool, in fact, not real time, I would say, but perhaps delayed by 1 to 2 hours, compiled by CME Fed Watch, CME Group. So just Google CME Fed Watch 2. They actually compile for us the market expectation of what the market has viewed in terms of the current data release, everything baked into that together, inferred by the Fed funds futures interest rate pricing. And from there, they calculate a probability of whether how much is being priced into the market in terms of the possibility of a Fed fund hike or a Fed fund cut. Okay, so with that, let's look at the probability tab. So the probability tab over here give us, the bottom one, give us a combined or aggregated meeting probability. So for those guys who are seeing this for the first time, let me explain slightly again what this table is about. So this table at the top is the meeting date. The meeting date is here. Then this one over here, this one here, this one here is all the various ranges of the Fed funds rate. Okay, how they deploy is 500 525. So you read it as 5%, 5.25%, and currently it's at 5.25% and 5.5%. Right. Go down the column here. These are the various remaining meeting dates so far this year, because it will not show the previous June, March, because it's over, right? No point showing that. So it will show us the upcoming FOMC meeting date. So what is FOMC? Federal Reserve Open. Put it away. It's a short form of the Federal Reserve meeting. They call it FOMC. Why they call that? Don't ask me why. I don't know. Some people ask me why FOMC. If you don't like the word FOMC, just put it away, that Federal Reserve meeting. All right. So I just use the short form FOMC, so that I hope you guys are pretty clear about this terminology. Okay. Meeting date of this FOMC is at the column over here at the bottom. Okay. So this will be the meeting date. Okay, don't ask me why it's being compiled by this date. I can't change it. Unfortunately, this American terminology or American definition of date. The first digit you see over here is the month, then followed by the day, the date. So this is July 31st, all right, followed by September 18th. Okay, so far so clear. Good. All right. So the July 31st meeting, which is upcoming one, which is about 2 weeks from now, market is saying the Fed stamp pad. Why? Because it's showing 93% chance of remaining the same at 5.25% to 5.5%. So that's the current Fed funds rate right now. Only a small chance of 7% that they will actually do a 25 basis point cut. So based on the current CME Fed Watch 2, which I'm getting, their data is inferred from the current pricing of the Fed funds interest rate futures market. So I hope that this is very, very clear. So this is the best that I could actually explain how these two works. All right. So no change. So, but what's interesting over here is that after the release of the US CPI data yesterday, the September meeting has shown a very, very high chance of close to 100%. Prior to yesterday, even the start of this week is about 70%, which is considered very high. So now what we could infer over here is almost 100% price in that the US Federal Reserve Bank, which is the US Central Bank, more likely or high chance it will do the first cut of 25 basis point in September 18. All right, so that is already being priced into the market. No big surprises anymore. So now the next key thing over here is to watch out for the November and the December meeting. So for the November meeting, now there is a slight increased chance of slightly above 50%, 53%. Previously, this was less than 50% prior to the release of yesterday's US CPI data. So now it's showing at 53% chance that it will actually cut in November. All right. And right now, what's interesting over here is that previously, at this point in time, right, in December, 59%, 60% chance it will cut. All right. But this 60% chance of a cut, right now, previously it was 90%. Okay, now 60% of another 25 basis point cut in 18th of December. But at that point in time, there could be a chance of a 250 basis point cut. Why? Why do I say that? Because if you look at it, 4.75% to 5.5 is 59%. Previously, this 5.5% to 4.7% was very low, about 20%. So now it's increased to 40%. All right. So what it means over here, right, there is a chance of it doing much more aggressive. Instead of 25 basis point, it could actually go down. The possibility of 50 basis point cut is 40%, but previously it was only 20%. So there was a big jump of 20 of an incremental in odds over here. But net, what we are seeing over here is at this point in time, at least 2 interest rate cuts before 2024 ends. But that has already been more or less been priced into the market yesterday, even before the release of the US CPI data. So what does it impact on the stock market? So very interesting, right? If you look at the US stock market yesterday, we do see a rotation, which I really expected. Why? Because of the steepening of the US Treasury yield curve. For those who are hearing for the first time, what is the steepening of the US Treasury yield curve? Later, I'll touch on during the intermarket dynamics. But for those who have been following my daily dose since the start of this week, I've been hammering on this US steepening of the yield curve and its impact of the rotation. That means, i.e., I do expect the laggard to catch up, which is the Dow Jones Industrial Average, which has a high component in value-oriented stocks. So what is value-oriented stocks? Stocks that are cyclical, industrial, and banks, as well as energy. So yesterday price movement, right, very interesting. What we see over here is that we see a sell-off in the S&P 500 and the Nasdaq 100. They are down negative 0.9%, and the worst hit was the Nasdaq 100, down negative 2%, because the Nasdaq 100 is much more heavily weighted on the mega cap stocks that has been leading the fort since the start of this year. So we could see over here is that after the release of the US CPI data, market initially bounced, hit fresh all-time high, then thereafter it sell off throughout the US session. All right, very similar for the Nasdaq 100 as well. Bump up to a fresh intraday all-time high. Okay, let me go back again. Okay, give me a minute now. Oops. Okay, sorry about that. Okay, so now let me open up the chart, trading view. Okay, it's a bit lagging now on the internet. Okay, hopefully, because I want to let you guys see the intraday trend yesterday. Okay, oh gosh, I don't know what's going on with my internet again. Okay, give me a few seconds, hopefully it works. Okay, it doesn't seem to be coming out. Okay, good, lucky it came out. Okay, so now where was I? So, okay, so I wanted to share with you all the trend, the intraday trend of the S&P 500, which managed to do a pop-up after that release of the US CPI data. Then thereafter it sell off throughout the US session. And very similarly, the sell-off was more pronounced on the Nasdaq 100, down negative 2.24%. If you look at it over here, okay, same thing, it pop up to an intraday high, that means a fresh intraday all-time high. Then after that, it sold off. But what's interesting over here is that the Dow Jones Industrial Average managed to hit outperform and thereafter trade sideways. And the one that is the most lagging behind since the start of the year was the Russell 2000, positive 3.6%. All right. So what we could see over here is a rotation of the prior leading cohort, which is the Nasdaq, followed by the S&P 500. On an intraday basis, they sell off, but this sell off, they rotate into Dow Jones and the Russell 2000. So a lot of people ask me, is this healthy or is this start of a 20% corrective decline? The answer I will share with you all later in my intermarket dynamics. Okay, so now let me touch on more about the performance of these cross asset classes first. So very clearly, what you could see over here, this is the sell-off that took shape yesterday in the mega cap stocks over here, all the mega cap stocks, the 7 mega cap stocks sold off, and this sold off rotate into the rest of the S&P 500 sectors. All right, the banks, the healthcare, the industrial, the consumer staples, and real estate, as well as utilities. Okay, now that is for the news flow related to the US CPI data. Okay, and what's interesting over here is that the US CPI data managed to see an acceleration of that dollar strength sell off, which also came beyond expectation. So yesterday in my daily dose, I do highlight the continuation of the intraday dollar weakness, which actually took shape, where the euro dollar, the sterling dollar, as well as the Aussie dollar hitting our resistance level that we highlighted in our daily dose for those who actually follow our daily dose yesterday. And I also did mention very clearly in my daily dose yesterday that I'm not so convinced the conviction of the dollar yen moving much higher, despite the fact that they are trading sideways before the US CPI data. That means the dollar is still pretty much resilient against the other currency, because I did highlight that other currency, the euro, the sterling, the Aussie is showing dollar weakness against the other major, but the dollar yen is not showing yet. Then this is what happened yesterday, where actually the dollar yen actually broke down. All right, so if you look at the movement of the dollar yen yesterday, it actually broke down the most dramatically. All right, so this broke down of the dollar yen over here yesterday, it came down, right? So yesterday we turned neutral on the dollar yen, okay, because we are very cautious of it chasing the dollar yen intraday bullish trend. Okay, because what I highlighted yesterday as well, you can actually take a look back at yesterday's YouTube video. Okay, I share with my my prognosis of why I'm not confident of playing that bullish intraday on the dollar yen, which turned out to be true. It came back down. So the reason of this huge plunge of the dollar yen on the intraday basis right upon the release of the US CPI data, two things could be likely happen. Number one, there are prior lots of intraday bullish positioning on the dollar yen where stop loss got squeezed on the downside. And secondly, there could be also the Ministry of Finance of Japan taking this opportunity to intervene in the dollar yen market. That means, i.e., they could potentially be selling dollar against the yen, taking advantage of this potential squeeze down of the dollar yen as well, given that perhaps there are players out there who are actually extreme net long dollar yen position ahead of the release of the US CPI data. But nevertheless, the Ministry of Finance, as usual, they go dark. They didn't actually acknowledge. They actually because they were quizzed by the major press yesterday that do they actually intervene the market. So they actually keep mum, neither saying yes or no. But what they did mention over here is that they're saying that the movement of the dollar yen is going against the fundamentals. Okay, this is what the biggest statement they released yesterday. But nevertheless, later I'll still touch on what are the key levels to look out for, okay, on the dollar yen. So what we could see over here is that yesterday's steep plunge, now the price starts to do a bit of normalization, a sideways movement. Okay, it's pretty much normal, all right, over there from a intraday perspective. And other news flow I want to highlight to you all over here is China. It's more related to China. So China yesterday made quite a shocking announcement saying that they will crack down on short sales, preventing quantitative hedge funds that are focusing on China stocks, to preventing them from shorting China related stocks. All right. So, and also they will also raise the margin deposits for investors or funds who wants to borrow stocks for short sale. So this announcement came in line with next week key important data or event on the China, which is why I call the third planet, all right, which will be held on the 15th of July to 18th of July. So it's actually this data is more, this particular event is where the top leadership of China gathered and rubber stamp the next 3 to 5 years key economic agenda to drive China economic growth. All right. So most likely it will be more driven on very focused on industrial. That means, i.e., transforming China into a high-tech growth player and also sourcing out for key semiconductor related chips or component that US right now is preventing China from getting. Okay, but market participants are still looking out for, is there any chance of a higher fiscal stimulus spending and monetary policy stimulus to jumpstart their local economy, okay, instead of favoring industrialization. Okay, because right now the key aim of the top China policy makers is now shifting towards high-tech industrialization. That means focusing only a key component part of the China economy rather than a bigger portion of measures that stimulate consumer confidence, stimulate business confidence via heavy infrastructure investment. That means they do not want to visit the previous playbook again. That means the previous playbook, any slowdown in Chinese economy, the government will come in with all out stimulus measure, infrastructure investment, primarily focusing on the property sector, lowering the interest rate so that the property developers can get easier, cheaper access of funds, and house owner could actually get cheaper borrowing mortgages, house mortgages. But the China top leadership do not want to follow this playbook again. They want to shift to what I call quality growth. And one of the quality growth they are actually looking at is to jumpstart a very niche industrialization policy, which is high-tech industrialization that's focusing on AI, focusing on biotech, focusing on semiconductor, right? So that's only very niche, but we are still watching if there's any chance of any hint of looking to revive the property market in China, or even some form of physical stimulus to come up to actually increase consumer spending via, it could be via what you call it a tax cut or additional one of what you call that a tax we call it rebates to actually jumpstart disposable consumer spending. So something to look out for between July 15 and 18. But nevertheless, right, yes, yesterday's announcement, right, of this crackdown on short sales did indeed boost the Hong Kong stock index, okay, or the Hong Kong Hang Seng Index, which we also expected yesterday. For those who follow my daily dose, we do expect on the Hang Seng Index to shape that bullish reversal right above the 17,100. Resistance have already been met, yes, on the Hang Seng Index. So later I'll touch on more about what are the key levels to watch out for on Hang Seng Index. So what we could see across the board today morning, very positive. Hang Seng Index is up by 1.9%. The HSCEI, the H shares that is listed, or China shares that are listed on the Hong Kong Stock Exchange, is up by 1.7%. The Hang Seng Tech Index, that's called the China Big Tech index, is up by 1.4%. And if you look at the CSI 100, it's almost unchanged at negative 0.12%. So net is still rather positive on the Hang Seng index. And most importantly, if you look at the CSI 300 real estate, you could see my mouse right now. So this is the one of the key benchmark index I watch out to gauge the health of the China real estate health. So the China real estate index, which is a benchmark for the China property stocks, is actually outperforming right now, up 4.6%. So I believe that it's more or less related to the short sales, because we know that the short sales band, or the short sales curve. So we know that the China property market is still in doldrum. A lot of these quantitative hedge funds are looking to actually short sell China related property stocks. So with that ban, or with that restriction of that short sales, so they're actually expecting a short squeeze up in the real estate index. Okay, so that's pretty in expectation. All right, so this is the key events, news flow, and their impact on the market. About cover. Okay, so right now, let us now touch on the fundamentals and the intermarket dynamics. Okay, so as usual, I will start on with the US Treasury yield curve first. So for the US Treasury yield curve, what we are seeing over here is that the 10-year government bond, okay, finally break down. Okay, it broke down and shape a kind of lower low. Okay, so right now it's trying to break below the previous low of 19th of June, the 10-year. But if you look at the 2-year government bond, which is the lower 10-year one, okay, 2-year government year, it continues to plummet at a much more higher magnitude. Okay, so very clearly it's shaping a very clear lower low. So the 10-year is lagging behind. So what it means over here is that the market participant now is pricing a much more dovish Federal Reserve. All right, so that means, i.e., the Federal Reserve right now is expecting to actually be more aggressive in terms of starting out a potential interest rate cut cycle, rather than having a wait and see approach, because them being data dependent in the start of this year, there are now very clear evidence that inflation is indeed slowing down in US. Some signs of economic growth has started to get sluggish, especially the US ISM Services PMI, which has really plunged to negative territory below 50. That was 2 weeks ago. And last week, non-farm payroll data is also showing signs of softness in the US job market, where the previous 2 months, May and April, revised downwards, and the unemployment rate in US tick up from 4% to 4.1% in June. So net, all these key economic data that the US Federal Reserve is watching, telling market that they are data dependent on this data. All this data is indicating softness in the US economic growth. Haven't led to recession yet, but softness. But inflation has really started to decelerate. So it gives them justification to kickstart a interest rate cut cycle. So that's being priced in by the 2-year Treasury yield that is falling down at a faster pace compared to the 10-year US yield, because the 10-year US yield also showing is also a measure of US economic growth, because right now the US economic growth is still showing no signs of a hard landing yet, based on the data that we are looking at right now. So, but with this 2-year Treasury yield that is falling at a faster pace versus the 10-year Treasury yield, is what we call a bull steepening scenario. So what is this bull steepening scenario? So let me share with you in my screen over here. Okay, this is the bottom. Okay, so this is the bull steepening. All right, so very clearly the difference between the 2-year minus the 2-year Treasury yield minus of the 10-year Treasury. Okay, we are tongue twisting. My apologies. Let me repeat again. Is the difference where I get the 10-year Treasury yield minus of the 2-year Treasury yield. Okay, so in some major press they call it the 2-10 yield curve. Okay, this is how you read in the press 2-10 yield curve, but it's not 2 minus 10, it's 10 minus 2. All right. So previously, when at around April 2022 to March to July 2022, we see the yield curve inversion. So what's yield curve inversion? That means the 10-year minus 2-year goes into a negative territory. All right. So it went down into negative territory. So once this US yield curve invert goes into negative territory over here, it means impending US recession or hard landing. But ever since then, July 2023 all the way until now, the yield curve has starts to now uninvert. That means it starts to actually plateau off and curve up. Okay, so once it curve up over here, the way how it curve up over here, there's two possibilities. It could be a bear steepening and a bull steepening. So a bear steepening over here is not good, but for a bull steepening is special, is good for the economy. So a bull steepening, what it means over here is that the 2-year is falling faster than the 10-year. All right, as I showed you earlier on. So right now, the key thing over here is that it slowly starts to steepen, and if it starts to break up above a key resistance at negative 0.08%, very high chance that it will continue to steepen further, and the entire yield curve inversion is no longer intact. That means it goes above the 0%. And what I can share with you is that the previous steepening as well that took shape in November 2020 all the way up to March 2021 has managed to see the value factor inside the S&P 500 outperform against the normal S&P by looking at the S&P 500 Enhanced Value ETF, SPVU. Okay, so for those who follow my daily dose at the start of this week, this shouldn't be what I call it, a strange things to you. But for those who are hearing this for the first time, let me explain to you what does it mean. Okay, so this is a S&P value ETF. Okay, they didn't change the component stock of the S&P 500, except that those stocks that has a higher value factor will be ranked at the top. So we know that value, right? Value stocks, good value stocks means that good balance sheet, low debt ratio, constant cash flow, constant net profit growth. Okay, over here. So some of these stocks that's a higher weightage are industrial stocks, banking stocks, because they are considered as a high value factor stocks. So these stocks will be ranked at the top, whereas those stocks that are growth momentum like Microsoft, Nvidia, or some of the mega cap stocks, they will not be at the top. Perhaps they will be at the middle part of the ranking based on this we call it rejuggling of this S&P Enhanced Value ETF. So what it means that previously over here, when the yield curve steepened, the value factor actually outperformed the S&P 500, whilst the momentum factor actually underperformed. Okay, so this momentum ETF, right, SPMO, same thing as well. What the ETF does over here is to rejuggle the weightage of the S&P 500 component stocks. That means those S&P 500 component stocks that has high momentum factor reading will be ranked at the top. So that's actually most of it is actually Nvidia, Apple, or whatsoever, the stocks that are driven up by momentum since the start of this year. All right. So what you could see over here is that the momentum stocks over here is still outperforming. Okay, never plunges. But what you could see over here is that the enhanced value now starts to tick up slightly. Okay, so that also explained to us the outperformance of the Dow Jones Industrial Average yesterday, and as well as the Russell 2000. So especially the Dow Jones, which is heavily concentrated by value-oriented component stocks like the banks, the cyclical, which is Caterpillar, which is one of them, and one of the healthcare stocks, United Healthcare. All right. So if this bull steepening continues and break above the negative 0.8% key resistance, we do expect the value factor outperformance to come into the market, and potentially down the road we could see the Dow Jones that is lagging, and the Russell 2000 that is lagging behind the S&P and the Nasdaq 100 continue to play that catch up. All right. So now with that in mind over here, the next key thing we'll ask ourselves still the intermarket dynamics, that yesterday's sell-off in the S&P and the Nasdaq 100, is it the start of a significant 20% or 10% corrective decline? So the odds are very, very low. Why? Because the market breadth continues to improve. especially on the S&P 500. Okay, still remember that for those who are new, I'll explain to you what is this. For those who follow my daily dose on a frequent basis, this shouldn't be a big, we call it question mark to you guys, because I've been covering this as well as a market breadth gauge to gauge the health of the US stock market. So let me start with the S&P. Let me start what is this about first. So this is actually telling us the short term and the medium term market breadth. So I'm looking at the percentage number of stocks inside the S&P 500, which is this turquoise blue and this whatever light green line. This turquoise blue line is telling us that percentage of S&P stocks above the 20-day moving average. And this green line here is telling a percentage of S&P stock above the 50-day moving average. That means, intuitively speaking, I want this line to slope upwards, this both line to slope upwards. So telling me that more S&P stock are now trading above their respective 20 and the 50-day moving average. So previously, since the start of this week, right, the amount of stocks above their 20-day moving average is still very low at 40%, but it's still showing a higher low as compared to 13th of June and compared to 30th of May. So it's slowly improving. And yesterday, it actually jumped a big improvement. So now, after yesterday's rotation into other stocks instead of the mega cap stocks, it rotated out. And it's a healthy rotation. Why? Because now there are 75% of the component stocks that are trading above the 20-day moving average. Very similarly, on the 50-day moving average, previously it was below 50 at around 39%, but this 39% it showed a higher low compared to the low of 20th of June and 20th of May. And yesterday it shows a big jump as well to 62%. All right, so are you telling me that this is the start of a 10 or 20% corrective move, given that the market breadth of the S&P 500 of the due as seen on the percent number of stocks that are trading above their 20-day moving average and the 50-day moving average has shown a significantly big improvement yesterday? The answer is very low odds of a 10 to 20% chance right now. And even the Nasdaq 100 sold off yesterday at negative 2%, but their market breadth is still healthy by looking at the percent of Nasdaq 100 stocks above the 20-day moving average, and the percent of Nasdaq 100 stock above the 50-day moving average is still shaping a higher low, and all of them are still relatively constant above the prior day movement. So the prior day movement before the sell-off was at 60% for the percent of stocks above the 20-day moving average. Okay, 60% over here. Okay, prior day, this was Wednesday. So on Wednesday, it was at 66%. And yesterday, movement was also the same at around 66% for the percent of Nasdaq stocks holding above the 20-day moving average, despite the sell-off of the Nasdaq 100 yesterday. Okay, oops, where was I? Okay, sorry about that. Similar for the percent of Nasdaq 100 stocks above their 50-day moving average. So what we could see over here is, in fact, this one improved much more better. All right, so yesterday it jumped up to 67%. The prior day on Wednesday is at 65%. So there's a 2% increase jump. All right, so overall, right, the market breadth, even though the Nasdaq 100 itself sold off yesterday, is a worst performer, but the market breadth of the Nasdaq 100 as inferred from the percent of Nasdaq 100 stocks trading above their 20 and the 50-day moving average are still showing in a healthy bullish environment. All right, so with that, again, we're talking about when Nasdaq 100 starts to shape at the start of a severe correction of 10% to 20%. The answer, like I share with you again, like I would like to say, inferred from this market breadth indicator, low odds. All right. Okay, so that's sum up the very interesting intermarket dynamics that is playing out right now, especially inside the major US stock indices. Okay, today is a bit long. Why? Because I need to explain to you all the mechanics behind it, and also I need to explain to you all what are these indicators about for those guys who join us for the first time. All right, so I hope that I make it as clear, as simple as possible, not too complicated for the understanding. All right, so if you are still unclear, you can just take a look at the YouTube video later on, which I will release it later at 1:30 to 2 p.m. Singapore time. Okay, so without further ado, now let us now jump straight into the short-term intraday technical outlook on the FX market first. All right. Okay, let me save this. Okay, and let me expand my screen so that you guys could see. Okay, so FX market. Let us start with the euro dollar. All right, so for the euro dollar, yesterday the market actually hit our resistance and now managed to do a pullback. So given that today is Friday, there could be a chance of a minor setback after yesterday's strong rally. So with that, I will actually flip to an intraday bearish bias on the euro dollar, not the start of a very severe corrective move, but more of an intraday pullback scenario. So flip to a bearish bias for today, because also it will hit the top of the minor ascending channel. So as long as 1.0925 short-term pivotal resistance is not surpassed to the upside, flip to a short-term intraday bearish bias on the euro dollar for this potential minor pullback scenario to take shape. First near-term support level to watch will be at 1.084. Below it exposes 1.0805. We also confluence with the lower limit of this minor ascending channel that I drew from 26th of June, and also confluencing with the 20-day, the 200-day moving average and the 50-day moving average that is soon to be acting as a support at this 1.0805 as well. Only an hourly close above 1.0925, that means a spike up above 1.0925 will see the continuation of this intraday bullish bias move. That means the minor setback has been invalidated, continuation of the bullish intraday sequence to test the next near-term resistance at 1.0945, followed by 1.0960. So this 1.0960 is rather important. Why? Because if you look at the daily time frame chart, share with you all. Okay, this 1.0960 over here, okay, 960, okay, is in fact confluencing with the medium-term descending trend line of the symmetrical triangle that is in place since 19th of July 2023 on the euro dollar. All right, so that's sum up for the euro dollar. So now let us move on to the sterling dollar. All right, so on the sterling dollar, the cable also rallied and hit our resistance level at 1.294, 1.294, yeah, 1.294 exactly. So what is 1.294? Upper Fibo extension level, 0.618, taken from the low of 27th of June. So this could be a fifth wave target already. 1, 2, 3, 4, 5 wave up. So after 5 wave up, there could be a potential much more deeper corrective pullback, at least on a minor time frame. Why? Because it's hourly chart. And also this 1.2940 is also confluencing with the upper limit of this minor ascending channel that I drew from the low of 2nd of July, and as well as this long-term descending trend line that I drew from the 2nd of June 2014. That's close to about 10 years ago. So with that, there's a key inflection level that has really been made. RSI right now, it has already been exited from an extreme overbought level, indicating to us that there could be some form of working out to do to actually go back to normalcy again around this support area over here, right? And even at the oversold level. So with that, potentially there could be a chance of a minor setback on the intraday basis for today. So flip to a bearish bias, 1.294 short-term pivotal resistance level to watch out for. First support level to watch, in fact, there could be a minor one. Yeah, this level here. Okay, the lower limit of this long bullish Maribuzu candlestick at 1.2875. A breakdown below 1.2875 exposes the next near-term support at 1.2845, 1.2825. We also correspond to the lower limit of this minor ascending channel from the low of 2nd of July. Only an hourly close above 1.2940 will invalidate today's intraday bearish bias for that minor setback scenario to see the continuation of the bullish impulsive upmove sequence towards the next resistance level at 130 figure slash 130.10, followed by 130.40 slash 130.65. Okay, that's for the sterling dollar. Moving on, next will be the Aussie dollar, the dollar measure against the Asia Pacific currency. So the Aussie dollar, same thing, also hit the first resistance that we highlighted. We have two resistance, 68 figure, followed by 67.80, followed by 68.25, 68.40. So it already hit that level. Also the upper limit of this minor ascending channel that I drew from the low of 28th of June. So given the fact that it could also shape that minor corrective pullback towards the lower limit of the minor ascending channel. So with that, I'll be using 68 figure as my short-term pivotal support for today. And also given the fact that if you look at the RSI also seems to be breaking below a former minor ascending trendline support. All right, so with that momentum not that strong, so we'll be flipping to a short-term intraday bearish bias, 68 figure level for that minor setback to play out. Setback support level to watch, 67.20, followed by 67 figure level. We also corresponding to the with a breakdown of 67.50 first. All right, so for sure this level got to break. So 67.50 break exposes 67.20/67 figure level, which correspond to the lower limit of this minor ascending channel from the low of 28th of June as well. Only an hourly close above 68 figure will invalidate today's intraday bearish bias for that minor setback scenario to see the continuation of the bullish impulsive sequence. Near-term resistance to watch after 68 figure, 68.25/68.40. Above it exposes 68.70 on the Aussie dollar. Now, very interestingly, on the dollar yen. Okay, so on the dollar yen, what we see over here is that this is the big move down yesterday. All right, so where is it right now? It managed to actually help on to the 158.35 support level, which is the former minor swing high, and as well as the 50-day moving average acting as support, and also the the medium-term ascending trend line support that I drew from the low. Okay, in fact, not medium, the major, yeah, the medium, correct. The medium support is less than it hasn't reached a year yet. Anything that is a year and above is major. So this is still a medium-term ascending channel support taken from the low of 28th of December 2023. All right, it's going to bounce over here. So there's some form of support coming in after that sell-off yesterday. But what's interesting over here is that this support bounce, this potential bounce from the 50-day moving average may not be as strong as in the past to see higher high. Why? Because of this bearish divergence that is being formed on the RSI. Notice there's a bearish divergence here. Okay, higher high on the price action, higher high on the price action, but lower high on the RSI. So yes, we may see a bounce on a very short-term basis, but this bounce on the hourly this bounce that is taking shape right now may not start to lead to a higher high in terms of what we're seeing right now on the current technical key elements on the daily chart of the dollar yen because of this bearish divergence. Okay, so this is something to bear in mind for longer term perspective. But on the shorter term perspective, yes, we can still expect a bounce. So on the shorter term for today, okay, yesterday we were neutral, right, between this 61.95 and 61.10. It broke below the neutrality range, plunged all the way down, hitting the support level at 158 level. Okay, so what I'm going to do over here is that I will use yesterday's intraday low, because right now the price action already starts to exit from an extreme oversold level. It hasn't even hit the overbought level yet, so there could be a chance of a minor bounce taking shape. All right, so how high this bounce can take place? So let's say if this is the start of a much more deeper bearish move instead, so what I did over here is that I can actually do a Fibo retracement of the entire move. Okay, about 61.8% over here. That's 60.30. All right, so with that over here, using 15745 as my short-term pivotal support for today, flip to a short-term, only a short-term intraday bullish bias for this potential minor bounce to take shape. Resistance level to watch, right, will be at 160.30, above it 161.10. All right, then thereafter, once it hit this region over here, we got to be extra cautious. Why? Because of that bearish divergence that is flashing on the daily time frame. All right, so that I could make myself pretty much clear. So yes, it could be a bounce, but this bounce could be only intraday in nature because of that bearish divergence that is being flashed out on the higher time frame chart, which is the daily chart that I show you. Okay, but however, if today it didn't goes up and continue to plunge down and break below 15745, forget about any intraday bounce. That means the bearish impulsive down move will resume or likely resume. Next support level to watch will be the 0.618, 0.764 Fibo retracement extension on the downside, 15665, 156 figure level. We also confluence with the graphical area of 13th of June and as well as the minor swing low of 12th of June. Right, so that's for the dollar yen. So with that, let's sum up for today's intraday outlook, technical outlook on the major FX pairs. So now let us move on to the major stock indices, starting from the Asia Pacific, the Hang Seng Index. So the Hang Seng Index yesterday, we were bullish. Okay, it really broke up from that. Once our resistance level is 17,970, broke up above it. So before we go to the hourly time frame, I want to share with you all on the daily time frame. So what I could see over here, right, this daily time frame, it actually broke out from a descending bullish descending wedge configuration. That means what it means over here, that the appearance of a descending wedge indicate to us that this could be the terminal low of this 8-week of decline. That means, i.e., given this strong push up over here, there's a chance, high odds, based on a technical analysis perspective, that this low here, which is also close to this 200-day moving average, this could be the start of a new multi-week impulsive up move. All right. Okay, so this is what, based on the technical elements that we are seeing right now. Okay, but on a daily intraday basis, we are taking things one step at a time first. All right, so now flip to an intraday basis. So for intraday basis, for sure, right, the short-term pivotal support level to maintain this ongoing bullish bias will be at 17,970. Okay, anything cannot be higher than this level, because this level is the pullback line of this descending resistance, now turns into a pullback support level. If it goes below it, that means this morning is considered as a failure bullish breakout and so close to the 20-day moving average as well. So as long as any minor pullback managed to hold above 17,970, we'll still maintain that short-term intraday bullish outlook on the Hong Kong 33. Next resistance to watch, 18,450 on a near-term basis, which is the minor swing high of 19th of June, followed by the minor swing high on 5th of June at 18,690. Okay. However, if we start seeing an hourly close below 17,970, then it will be invalidate this bullish breakout. That means it's a failure bullish breakout. The Hong Kong 33 will shape another choppy corrective decline again to reintegrate back into this area over here. Next near-term support level, 17,790, followed by 17,585 on a intraday basis. Okay, so that's for Hong Kong 33. Now, moving on will be the Japan 225 over here. Okay, so the Japan 225 yesterday, it plunged below our Titan key short-term pivotal support around 41,600 level and hit the next support level at 41,090 level over here. Okay, this congestion area here. And what's interesting over here is that the hourly RSI now has started to shape a bullish divergence right after yesterday's sell-off. Okay, that's a bullish divergence. So with that, it really hit the second support level, and with this bullish divergence, there could be a chance that it may not, that this corrective pullback may pause at this juncture on the intraday basis. So I'll be using 41,090 as my short-term pivotal support level for a potential pause or consolidation of this ongoing corrective pullback level. And also there's 5 wave down already, 1, 2, 3, 4, 5. If you look at the 5th wave target over here, is at 0.618 right now. Okay, so there could be a chance of a corrective rebound to retrace this 5 wave down. All right, so this 5 wave down movement in terms of FIBO, it could retrace at the 50% or 61% FIBO retracement. If I do it over here, 50% is at 4182, 61%. Okay. Yeah, sorry. Let me do it again. Oops, the FIBO retracement. Okay, 50% is at 41,820, and the 61% is close to the 42,140 level. Okay, so with that, using 41,090 short-term pivotal support for today, looking for at least a pause in this 5 wave down. That means there could be a chance of a corrective snapback rally. First resistance zone level to watch, 41,820, followed by 42,140. Then from there, we see how the price goes. All right, because after 5 wave down, then you retrace up, then there could be another deeper leg of corrective pullback again taking shape to retrace it down to cover the gap, and that means kind of a retest of that 20-day moving average again at around 40,250, 40,000 level. All right, but however, for today, if we start to break down again at 41,090, that means forget about that corrective pullback or snapback rally. The price action will resume its corrective decline, 48,080 followed by 40,250. Okay, so that's for the Japan 225. Okay, so with that, now let us move on to the German 30 or the German DAX. So the German 30, German DAX is a very, very tough one to play. So yesterday, it surpassed the short-term pivotal resistance level at this 18,518. So it seems to us that since the low of 14th of June, it's now start to oscillate within a expanding wedge configuration. And right now, with the yesterday breakout of the 18,500 level, it seems to us that now it's trying to inch back up to retest the upper limit of this minor expanding wedge. All right, so with that, I'll be using this short-term pivotal support level over here. That means I'll be using this level, which is yesterday's low, minor swing low at 39,420. Okay, adjust it a bit. Okay, so as long as this 18,000 not 18,000, pardon me, a bit of time to think out, so I adjust it slightly. So as long as 18,420 short-term pivotal support holds, this German 30 potentially could see a further intraday push up. Next resistance level to watch in the near term will be the minor swing high of 5th of July and 8th of July at 18,640. Above it exposes the upper limit of this expanding wedge configuration that is in play, 18,750. We're also confluencing with the minor swing high of 5th of June. Only an hourly close below 18,420 will see it floating down towards the lower limit of this expanding wedge. First support level to watch out for 18,235, which is so close to the 20-day moving average, and the minor swing low of 10th of June, 10th of July. Below it exposes the key support of this expanding wedge lower limit, which is being supported since 21st of June as well, that helped the price action from going lower. I think as a confluencing at the support at 18,085 level. All right, so that's for the German 30. Now, moving on will be the major US stock indices, the US Wall Street 30, the Dow Jones Industrial Average. So the Dow Jones Industrial Average going to hit our resistance level before it traded sideways, which is 39,900, slightly below the current all-time high area of 40,055. So with that, I will have a tightened key short-term pivotal support for today, because this will be the former minor range resistance, sideways resistance broken out, turns to a pullback support. So as long as this tightened key short-term pivotal support level holds, 39,620, still maintain that short-term intraday bullish outlook on the US Wall Street 30. Above 39,900 sees a retest of the current all-time high area at 40,055. Above it sees the Fibo extension of one time over here, taken from one time of the Fibo extension from the low of 14th of June, and also very close to the two-time Fibo extension from the low of 31st of May at 40,340, 40,440. We also confluencing with the upper limit of this minor ascending channel that I drew from the low of 14th of June as well. However, only an hourly close below 39,620 will invalidate today's intraday bullish bias to see the Dow Jones Industrial Average to shape a minor corrective pullback scenario. Next near-term support that it may test is at 39,325/39,190, which is the lower limit of this minor ascending channel that I drew from the low of 14th of June, and also correspond to the rising 20-day moving average as well, and the 50-day moving average as well, that is acting as a support at 39,190 next, right? So that's the US Wall Street 30 or the Dow Jones Industrial Average. Okay, moving on with the Nasdaq 100. So Nasdaq 100 yesterday underperformed. So actually it broke below our tightened key short-term pivotal support at 20,470. But right now, it paused at the next support level at 20,210 and slightly below the 20,060 level, which is the 20-day moving average. So it seems to us that it really starts to shape that pullback, okay, to cover the gap that it has left a few days ago above the 20-day moving average, and also the lower limit of this minor ascending channel that I drew from the low of 31st of May over here. So with that, I'll be using the 20,060 level as my short-term pivotal support, which will correspond to the rising 20-day moving average. Looking for at least a minor recovery for today. That means still maintain that short-term bullish bias. Resistance to watch in the first term will be at 20,470. Okay, 20,470 will see a retest to the all-time high area at 20,620, 20,710, where the pullback shape yesterday. All right. However, if we start to see an hourly close below 20,060, then this minor corrective pullback will extend. That means we'll invalidate today's bullish bias to see it exposing the next near-term support at 19,660, 19,520. All right. So that's sum up for the intraday technical outlook for the major stock indices. So let us now move on to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, it's a bit like the dollar as well. So a bit of dollar strength bounce coming into play, because the XAU/USD also hit our resistance level yesterday at 2,410 level. Okay, hit it level, and so I'll be using 2,425, which is yesterday high, and also correspond to the upper limit of this minor ascending channel from the low of 26th of June. So very likely it could start to shape that minor corrective pullback to retrace back down towards the lower limit of this minor ascending channel, and also given the fact that the hourly RSI has already started to exit from the overbought level and hasn't even hit the 50% and even the oversold level yet. So using 2,425 as my short-term pivotal resistance for today, flip to a short-term intraday bearish bias for that minor setback scenario to take shape. 2,391/2,383 will be the first near-term support level to watch. Below it exposes 2,368, which confluence with the minor congestion area of 9th of July and the lower limit of this minor ascending channel that I drew from 26th of June. And if you do the Fibo retracement to retrace the entire up move so far, okay, it also corresponds closely to the 38%, right, at 2,368. Okay, only an hourly close above 2,425, that means a breakout with hourly close above 2,425 will invalidate this short-term minor setback scenario to see the continuation of the impulsive up move. Next resistance 2,435, followed by the current all-time high at 2,450. Okay, that's for gold, XAU/USD. Lastly, West Texas crude oil. So West Texas crude oil continues to trade higher and hit the first resistance at 83.45, but right now it starts to shape a bearish divergence. All right, a bearish divergence over here. So with this bearish divergence, it indicates to us that this move over here indicate a lack of momentum, and also this push up over here also come in 5 wave, 1, 2, 3, 4, 5. All right, so given the fact that it comes in 5 wave with a 5th wave target at 0.618 or 0.764, also at slightly below 83.45. So with that, we will turn up to a neutrality sense, so perhaps it start to trade sideways below 83.45 and holding above the 20-day moving average at 81.97, which is also the lower limit of yesterday's intraday low. So neutral between 83.45 and 81.97 for today on West Texas crude oil. Only an hourly close below 81.97 will start to see a return of that corrective move to test 81.30, then followed by 80.56 next. All right, so that sum up the intraday technical outlook for today on the major cross asset classes. So before we go, let's take a look at the key economic data. What are the key things to look out for? So in terms of economic calendar over here, on Friday, today will be a rather quiet day, I would say, over here. Okay, give me a minute now. Where is it? Yeah, this is Friday. Okay, Friday. Yeah, Friday over here. So it will be a rather okay, just 1 second. I think it's not showing up. Yes, this day, yeah, Friday. So it will be a rather quiet session during the European session, except that what we have over here is the France inflation rate. So that's the final number out at 2:45 p.m. Singapore time. Then you have the US factory gate prices, PPI, at 8:30 p.m. Singapore time. All right. And also we do have another one at the Michigan consumer sentiment flash figure, the flash data for July out at 10 p.m. Singapore time today. And what we are interesting to see is the inflation expectation over here, because forecasting is expect to dip downwards slightly over here. All right, so something to pay attention to as well. And also the consumer sentiment data. So if the consumer sentiment data continues to turn upwards around 68.2, concessions at 68, looking at 68.5, so it's most unchanged. But if it comes down weaker, that could actually solidify the interest rate cut cycle to be kickstarted by the Fed. But what's interesting over here is that today is the unofficial start of the US earnings season. Okay, what do I mean by that? If you look at the earnings data over here, okay, so today you will see 3 major US banks announcing their Q2 earnings release. JP Morgan, Wells Fargo, and Citigroup. And JP Morgan has a significant weightage inside the Dow Jones Industrial Average. All right, and these 3 banking stocks are considered value-oriented play as well. And what's interesting over here is that so far, sell-side analysts has a low ball figure for their earnings release. So in fact, they are not so rosy. Why do I say that? So if you look at the current earnings expectation of these banks itself, scroll down over here. Yes, this is the one. So JP Morgan over here, based on the EPS expectation on the aggregate $4.15, below 1 year ago at $4.75. Citigroup slightly improvement, 1.39 versus 1.33 a year ago. Wells Fargo slightly improved as well, 1.29 to 1.25. Okay, so but net overall, right, if you look at the numbers of the EPS, all right, what market analyst is expecting is doesn't show a big jump from a year ago, right? A year ago there. So this was 1 year ago. This was now one they're actually expecting to release today before the start of the US session. So given that this figure, the expectation is on the low side of the tier, any earnings that means, i.e., there's a high chance of an earnings beat from this low ball expectation. Okay, something to watch out for, as JP Morgan, Citigroup, and Wells Fargo today released their Q2 earnings results ahead of the start of the US session at 9:30 p.m. All right. So with that, have a great Friday. I wish you a restful weekend, and we shall speak again on next Monday. This is Kelvin here, signing off. Thank you.